So we've broken it down essentially into three parts. So there's the robo-advisors, which they've come along in the last few years and essentially made things a lot simpler and easier to implement. They're not right for everyone. They don't necessarily take as much risk as other funds, which means it doesn't necessarily get you to your end destination as quick as perhaps other kind of more riskier funds. And as we mentioned before with the Nobel Prize winner, risk and performance is actually linked. So in general, the higher risk you take, so the strikers in the course that we talked about, so the higher kind of the smaller companies which are more riskier but will lead to greater reward, or the other striker, the emerging markets, which is higher risk but ultimately will give you better reward if you look at historical factors going back kind of decades, or even there's going back centuries. So you can go back and track investment performance to 1750s. So essentially the investment robo-advisors, the other one we looked at were deep discount brokers, and then the third one is wealth managers. So we're going to go into each one, these investment performance providers that each one that you can essentially pick your vehicle which is right for you. So what we're not going to mention today, there are peer-to-peer lending which we mention in other vehicles. We're not going to, there's a number of ones available, so Zupa, Lending Works and Rate Setter. There are others available. They're the three main ones that I've seen, and yeah, generally they're pretty much the same. I can't really tell the difference between each one. So it's up to you to pick which one essentially is right for you, and we cover more in other videos. The other ones we're not necessarily going to go into so much today is the trading accounts. There's a number of different trading accounts. So this course was aimed to provide good quality education for investing, but not necessarily for trading. So I've got I'm writing a trading course that covered trading in my upcoming book, Football Formation Asset Allocation. I traded commodities for a FTSE 100 company, and my highest daily gain was £940,000 in a day. We're not going to cover that in this course, but it's just to give you an indication of that's more on a speculative side, where we're looking at more long-term investing. So if you look at the graph that you should have on your screen, so I've split it into two. So put it into complexity and cost. So complexity and cost. So essentially, each platform charge you a fee, and some charge you more than others, and some investment vehicles are simpler than others. It's not necessarily right or wrong. It's what's right for you. So let's start off with, so one of the investment platforms is Moneybox. So Moneybox is quite simple, I'd say. It's low down on complexity. Essentially, it takes out money when you spend. It takes out money when you spend. So if you go and buy a coffee, for instance, or you go buy a TV, then a part of that money will get taken out of your account, and it will put into. It starts off with a savings vehicle, but you can actually do it an investment vehicle. So they charge a £1 per month fee for that, and they also charge a 0.45% platform fee. I should also say this is right. These fees are right at the time of recording. I've gone on the website. Some fees are actually quite well hidden, and I've just it was quite difficult to find some of these fees, but these were the fees that I found, and it aimed to give you good quality education. I'm not necessarily do your own research, but this is just education to give you kind of an indication of the best fees. So it's low cost and low complexity is Moneybox. So the pros of Moneybox is it's simple, it's taken from spending, so you don't really need to think about it. Whenever you buy a coffee, you're essentially investing there. There are three types of investment, so cautious, balanced, and adventurous. So it's simple, it's good for the beginner. The cons are it does actually encourage spending. So if you go and buy a TV, for instance, you're putting money into an investment vehicle, but you'd probably you'd save money if you just didn't buy that TV in the first place, or you didn't buy those shoes in the first place. So it kind of almost encourages or incentivizes spending, which I don't necessarily think that's a good thing. Another con is there's only 3 types of investment. So although it's simple, it doesn't give you that much choice. So that might be good for kind of the beginner, but if you're looking to kind of take more risk, or essentially a bit more complexity, or a bit more, it doesn't necessarily give you that. And it also doesn't automatic rebalance. So the 5th step is automatic rebalance. You have to go in and yourself and rebalance, which can be a bit of a pain. And it doesn't focus, there's no focus on investing, so it's almost too easy. It doesn't really highlight kind of the investment kind of side of things. That's Moneybox. Let's move to Nutmeg. So Nutmeg, the cost is 0.75 on the first 100,000 and 0.35 on proportion beyond 100,000. So yeah, that's quite a good, relatively cheap cost to pay. So the pros, it's quite simple. You can sign up quite quickly. It's relatively cheap. They have an ethical fund that you can choose, which is quite good. Which is handy to have. That's obviously for the long term. Investing ethically is going to be good for both your kind of peace of mind that you're investing ethically, and also good companies for good are going to be they're going to be kind of growth industries as well. So if you think kind of 50 years time, the companies that are going to be still in business are most likely going to be kind of the ethical companies that look after their employees, that essentially look after the environment, and also don't really invest for companies that do bad. So that's a good thing to have. It does automatically rebalance as well, which is another. If you're that 5-step method, you can kind of tick that off as well. So the cons of Nutmeg. So it's difficult to see what they're investing in. So for me, I maybe more of an advanced investor, so I quite like to see what they're investing in. It's quite difficult to see actually what they're investing in. Another con is it's too automated. I feel like I've lost control of my investments. I didn't like that. This is a personal opinion, and it's just information. Yeah, so it's almost too robotic. I didn't like that personally. But if you prefer like a kind of a very simplistic kind of, and it's good for the beginner. So yeah, that's something I didn't like, and it's quite defensive as well. So the gains you're not going to get in other funds that you can invest in. Some of the more advanced funds, you're going to get. It doesn't have the risk profile that kind of the other higher risk platforms use. Although it does, they do call it adventurous. It doesn't necessarily take there's not that many kind of emerging markets or small companies that they actually invest in. That's not necessarily a bad thing, but yeah, I thought it's kind of a con, one of the cons as well. So the next platform is Wealthify. So Wealthify it's quite cheap. The fees are really low, so 0.22% for any original plans and 0.66 for ethical, and they charge a 0.6 fee for managing that investment. So yeah, the pros. So we'll go through the pros and cons. So the pros is it's really low cost of fees. I like the pros. I like the brand. I think it's quite straightforward and quite fresh. They do invest in ethical investing, so I like that. It's quite easy to use as well, so I liked that, and also they automatically rebalance. So we've done the pros. Now let's do the cons. So even if there's also not as kind of risky as other platforms. So even though they call themselves adventurous, it's not actually that adventurous compared to other funds. Cons as well, they also, it's another one with robo-advisors. You kind of lose that control of investment, so you're not really educating yourself as much as you could do with other funds. And there's only a few choices, which can be a plus, that it kind of reduces that kind of paradox of choice where you're kind of inundated with kind of different fund choices. Some of the other platforms, there's literally thousands of different funds you can choose, whereas the robo-advisors kind of break it down to, so Moneybox has 3, I think Wealthify has maybe 6 choices, and then Money Farm, that we're going to get to next, has 7. I think Nutmeg has about 6 or 7 that you can pick from as well. So yeah, that's the pros and cons of Wealthify. So the last of the robo-advisors is Money Farm. So Money Farm is another robo-advisor. So the pros of Money Advisor is so let's go for the fees first of all. So the fees is the annual charge is 0.68%, so still relatively good value, and they have an underlying fund fee of 0.2%. So this is slightly higher than the other robo-advisors. So the pros of Money Farm, they've outperformed other robo-advisors. So they take a more active strategy in their investment fund choices. So their kind of selling point is that they've outperformed, and they take more of an active kind of managed fund, or manage essentially they take a more active role. There's 7 portfolios available rather than just a 3 for Moneybox. So they also have a good kind of options for pension. So it might be kind of good for if you're more the older investor. So they've got a good kind of fund, good calculator, a pension calculator, and they do actually auto rebalance. That's a good thing as well. So Money Farm, the cons of Money Farm, it's more expensive than the other robo-advisors. There's more options, so there's 7 compared to Moneybox. So although that's not necessarily a bad thing, it can be, if you just want a quick, simple choice, to pick those 7 might be a bit more challenging than the kind of if you've only got 2, if you've only got 3 to pick from. There's no ethical option either, so that's was a downside for me. So yeah, that's Money Farm. So they're the 4 robo-advisors that we mentioned. So now we're going to go into what I call deep discount brokers. So essentially, it's all brokers are it's a bit like the estate agent when you're buying a house. So they don't actually own the funds. They essentially, a bit like the house, like a estate agent don't own the house. They just essentially give you the platform to, like a middleman, to buy the fund. So what is a fund? Essentially, they're a basket of a number of different companies available. So the first one we're going to go to is Vanguard. So Vanguard, there's a very low ongoing cost, which is 0.2. So it's even cheaper than some of the robo-advisors. So that's a very competitive price. So it's got a number of different lifestyle funds to invest in. So similar to kind of the robo-advisors, it gives you a breakdown of, I think there's like 7 different funds to pick from, and it's kind of split between bonds and where you're lending money to companies or governments and equity, so shares in companies. So it's relatively easy to use, and also so it's got the kind of lifestyle funds that you can invest in, but it's also got hundreds or if not thousands of different funds to pick from. So it gives you those options to kind of pick those funds as well. Almost too many options where you're kind of, it's like the paradox of choice where you're kind of like, what do you pick? So they do have an ethical fund that you can pick as well, and there's a number of different kind of global funds that you can pick from. So Vanguard is a strong choice. So, and the downside, there's not too much downside to Vanguard. Not that I'm as I said, I'm impartial here, but maybe there's too many choices. It's maybe a bit more challenging to kind of pick which fund you pick, and some of the downsides to these index funds is you don't get to pick the companies you're buying. So sometimes if you're just buying an overall index tracker, so for instance, if you're buying the S&P 500, which is the tracker, the 500 biggest companies in the USA, you're buying, I don't know, you might be buying weapons companies, or you might be buying kind of companies that are building prisons, or kind of these companies that essentially do that are investing for bad. So yeah, you have to kind of be careful with. It's not just Vanguard specifically, but all the funds that you kind of have to look at what actually companies are you investing in. If that's a concern to you, maybe that's not a concern to you, but just to highlight it. So yeah, so that's Vanguard. So relatively good value, and if you pick the lifestyle funds, it can be quite simple to actually pick. So the next one is Hargreaves and Lansdown. So Hargreaves and Lansdown, so they're more expensive than, or the fees are higher than the other, especially the robo-advisors and Vanguard. So it's 0.45% between is that 200,000? So yeah, on the first 250,000. So that's a platform fee, but you also have to factor in the fees for the funds as well. So it's quite, with all these brokers, it's quite challenging to find each different fund, because there's thousands of different funds. Each different fund has a different fee. So I didn't want to go into all the different details today of each different fund, but depending on the platform you like, then you can do your own research and look at the different funds. So Hargreaves Lansdown is the more expensive of the deep discount brokers, because you're paying a fee for the broker fee, plus you're paying the fund fee as well. So, and they've got lots of different choices as well. Hargreaves, almost too many different choices. Hargreaves, it wasn't as easy as perhaps the other the other brokers to use. So the next one is AJ Bell. So this is the annual fund charge was 0.25% up to the first £250,000, and again, that's just the fee for the broker. So that's just a platform fee. You're going to pay other fees on top of that. So you're going to pay management. You're going to pay fund charges on top of that. So management fees. So the pros of AJ Bell, it's relatively cheap. So they kind of position themselves as relatively cheap kind of broker fees, and they give a good selection of the funds that you can pick from. I found AJ Bell, the platform, quite difficult to use. I didn't find it that kind of intuitive, even though they say on their website they kind of promote it as easy to use, but once you get in, it was quite kind of clunky and quite difficult to use. They had an unclear fee structure. I found it quite difficult to actually find the 0.25% on the first £250,000, and then they've got a 0.1% on between £250,000 and £1 million. So it took quite a lot of work to find that. They kind of hid it quite well. But yeah, generally it's all these brokers it's a bit like a commodity. There's no real differentiation between them, so it's kind of up to you to pick them, whichever one you like. So Interactive Investor is the next one. So they offer lots of kind of funds as well. The pros is they've got a flat fee, so you don't actually pay on all the other kind of broker fees, and even the digital wealth managers. They all had a percentage of your money. So essentially, as your money grows, their fee grows as well, which, using compound interest as well, that kind of will grow kind of massively over time. So the good thing about Interactive Investor, they essentially have a flat fee. So it's £9.99 a month, and that covers you for multiple of kind of fund accounts, multiple accounts. They have lots of choice of funds, and you can buy individual shares, which you can't on a number of different other platforms. So you can't buy on the robo-advisor, you can't buy individual funds either. So the downside is, there's lots of different choices. So Interactive Investor, you can kind of almost get lost in the kind of what you can do there. Because you can buy into the different the different shares, you can it's almost too much choice. Just a full disclosure, I actually use Interactive Investor. I had it originally when they called it there was a broker company called TD Waterhouse, and they went bust, or they got bought out by Interactive Investor, I should say. So I do actually use that for myself. So I find it quite easy to use it. So maybe because I've used it for so long, it's easier than other platforms. But yeah, there's no real differentiation between that or apart from the price. So moving on to Fidelity, again, they have a flat fee of £45, which is good. So if you've got less than £7,000 invested, and then it's only £3.75 a month, or 0.35% on an ongoing. And they have a standard fee of 0.35% as well. So yeah, no real difference. I quite liked the look for Fidelity. It was quite easy to use. The complexity was quite low. Yeah, I generally quite liked it. So that covers the brokers, the deep discount brokers. So that covers Interactive Investor, AJ Bell, Hargreaves Lansdown, and Fidelity. So that's kind of what I cover in the deep discount brokers, and Vanguard as well. I'd consider that a deep discount broker as well. And then moving on to the wealth managers. So if you want to get financial advice, there's a number of different platforms you use. The two biggest ones are St James's Place, and so their charge is 5% of initial fee, and then the portfolio will typically cost you 1.5% or 1.6% and 1.9%. So wealth managers, they tend to be quite good at hiding how much their fees charge. Full disclosure, I used to work, I was a financial advisor using St James's Place, so SJP, and that's how I know their fees. They've kind of got a lot of flack from kind of hiding their costs of fees, because they are expensive compared to the other platforms, but then you do get full advice. From using the vehicle analogy, I think of it like a chauffeur. So if you want to just get picked up and taken to where you want to go, not thinking about how to drive the vehicle, then using a wealth manager is kind of what the idea is. So you don't really even need to think about it, but you do pay for that service. So the other wealth manager is Brewin Dolphin, and I couldn't find their fees on their website. It's quite ironic. On their website they say they have an open and honest policy about fees, and then they don't share it on the website. So yeah, I don't have that information. So yeah, a Times report said that a lifetime allowance of pensions would cost over £100,000 over 20 years to use financial advice. So yeah, that's a kind of an overview of the investment platform providers available. So you've essentially, in three things, you've got the kind of the robo advisors, you've got the deep discount brokers, and then you've got the wealth managers. And then on a separate note, you've got trading account, which is kind of the speculative side of things, and they tend to, quite often they say that they don't charge a fee, they're free, but what actually they do have is they make their money by the difference between what they call the bid offer spread, the difference between the buy and the sell. So they encourage you to sell and buy much more frequency, and that's how they make their money. So that's like Saxo Marking, IG, eToro, and Markets.com. And then the peer-to-peer lenders are Zupa, LendingWorks, and RateSetter. And we talk about kind of the peer-to-peer lending in other videos. So where are you on the 5-step method mindset? This was time to implement your education. So don't just sit and learn, actually go out and implement. So the idea of this course was to provide you with the tools and to empower you to make better decisions with your money. So you now have the education, like the vehicle. We've given you the education, like teaching you how to drive. Essentially, all you need to do now is implement. So it's like opening out the door. Turn the key and to start investing, and you can drive with the wind in your hair to wherever you want to go. You have the choice. We're moving into the imagination age. So we started off in the information age, then the knowledge age, and now we're moving to the imagination age, where you can pick your destination wherever you want to go in life. You can head off into the sunset wherever you want to go. So yeah, this is Money Tips. My name's Neil Doig. Please like, please subscribe, please give us a review as well, and please tell one person about football formation, asset allocation. I hope you enjoyed your investing journey. Thank you so much, and please be in touch. We have investing accelerator programs if you want to learn more, and we also have a business course coming out. We have a productivity course coming out, and we also have a starting your own business, a side hustle course coming out. So exciting times. So they'll be with us soon. So yeah, please like, please subscribe, and please tell one person, and please review. Please give us a 5-star review as well, because it really helps us out. Thanks again. Platforms. So we've broken it down essentially into three parts. So there's the robo-advisors, which they've come along in the last few years and essentially made things a lot simpler and easier to implement. They're not right for everyone. They don't don't necessarily take as much risk as other funds, which means it doesn't necessarily get you to your end destination as quick as perhaps other kind of more riskier funds. And as we mentioned before with the Nobel Prize winner, risk and performance is actually linked. So in general, the higher risk you take, so the strikers in the course that we talked about, so the higher kind of the smaller companies which are more riskier but will lead to greater reward, or the other striker, the emerging markets, which is higher risk but ultimately will give you better reward if you look at historical factors going back kind of decades, or even there's going back centuries. So you can go back and track investment performance to 1750s.